Greetings and welcome to Asset TV Roundtable. I am Zama Zulu. In this segment, we will be discussing transition management. I'm joined by three experts on the topic. We firstly have Adam Bateman, who is the Head of Business Development, Strategic Partnership and Investor Services at Standard Bank. Kagiso Matlala, who is an equity sales trader, also from Standard Bank. And David McPhillips, who is a Senior Vice President for Portfolio Solutions at Northern Trust. Gentlemen, lovely to see you and welcome.
Likewise, Zama.
All right, so before we get into the ins and outs of transition management, Adam, let me maybe kick off with you. Can you just maybe explain to us what is transition management? Let's maybe just define it first.
Sure. Well, I'm going to kick off and then I'm going to hand over to my colleagues to contribute. So in the investment industry, transition management is a process that can be used to manage a change of investment strategies. So that investment strategy can be a change of a rebalancing of a portfolio, restructuring exercise, or commonly a change of investment managers. But the idea is that a transition manager is hired to manage the process from the legacy environment into the new sort of target environment from a portfolio perspective. And by doing that, a transition manager can add a lot of value in terms of managing the risks that are involved in that process, and also doing it in a very efficient way from a cost perspective. Things that will typically trigger a transition could be a change of asset consultants, an amalgamation of funds when you see, as we've seen recently in the past couple of years, where a big manager will buy out another manager, and the unit trust funds are sometimes amalgamated. And also the multi-managers are quite heavy users of transition management. But with that, David, do you want to?
Yeah, for sure. I think you've done a really nice job in sort of characterizing what is transition management. I suppose if I was to expand on that a little bit further, I would think about it, or I'd categorize it in sort of three broad pillars, so to speak. So to support every single transition, you've got an element of project management. So as Adam touched on, there's a lot of moving pieces. We've got asset managers in most cases on the legacy side, so the managers that are losing assets, managers on the target side, managers receiving assets. But then you'll also have a custodian, a bank that holds the assets. You'll have a reporting agent, potentially a fund accountant, pricing the assets on a daily basis. So we've got a lot of independent stakeholders that need to be involved, engaged, and candidly on the same page as every other party to the transition. So project management, in my eyes, is a huge component of transition management and something where we spend a lot of time. I'd also reference the reporting element of a transition. So when we're working on a transition, I go back to the old adage, if you can't measure it, it can't be managed. So everything we're trying to do is manage the risk on the front end, as Adam alluded to. So identify those risks, and then through the transition, build a strategy overlaid with that reporting element. So our clients, typically asset owners, in some case multi-managers, they have full visibility of what's going on within the transition. So think project management, pillar one, think reporting as pillar two, and then another key facet would be the actual execution of the transition. So going to market and trading the transition. And I'll hand off to Kagiso on that one.
And so I'll just step in on the trading. I mean, the execution part of it, it can be across multiple asset classes. But when coming to trading, if it's not done correctly, the potential costs and losses for a fund in those situations can be quite detrimental to the fund. And so the execution in the market, be it in equity market, fixed income, or FX, that's where the actual rubber hits the road, so to say, where the assets are moving into different names, into different stocks, etc., and kind of presenting the portfolio that the target manager wants. So that'll be the execution part of it, yeah.
Okay, great. So I think, thanks, James. I think we've now established, the context of transition management. So you've been quite clear that you're moving from a legacy portfolio to a target portfolio. We've got the three pillars, as you explained, David. You've got your project management, your reporting, and then the actual execution where you're doing the actual trade. So I think, have I covered that?
I think so.
Okay, fabulous. Okay, so I think now that we're all on the same page, that's great. Let's move forward now with our conversation. Now, I think it was you, Adam, you used an example of, let's say multi-manager, for example. I want to continue with that example for my next question. So let's say, for example, I'm a multi-manager. I have now completed a portfolio optimization exercise, and it spits out what I should be doing, whatever changes I should be making in my portfolio. What would happen if I decide not to appoint a transition manager? If I do not engage with a transition manager, what are some of the things that can potentially go wrong if I decide to execute this myself?
Yeah. So basically what the big value that the transition manager adds is really transparency, understanding all of the potential risks involved and the potential costs, whether those be explicit costs, trading commission, implicit cost, how the market is impacted, the way in which positions are purchased and sold. So absent of any sort of transition management overlay in that type of environment, you're flying a little bit blind potentially. Not in all cases, but a transition manager should bring lots of transparency to the process.
Okay, so transparency is
transparency,
very important.
It's managing, risk, ensuring that if positions are being traded out of the market, that you have other means to stay in the market, and that's largely where a transition manager will add value.
And I guess ultimately, it comes down to sort of expertise. Okay, so if you think of a traditional multi-manager, their expertise is in, as you say, sort of strategic asset allocation, modeling their portfolios, hiring managers, selecting managers, researching managers. They probably aren't as used to transitioning portfolios as a transition manager. The clue's in the name. We're transition managers. That's what we're doing every single day of the week. So we have, I suppose, the technology, the reporting, as I sort of touched on earlier, to really get into the weeds and look at the details and quantify, as Adam said, some of those risks and manage those risks. So again, we're big proponents of transition management across the panel here, so we are somewhat biased. But I do think expertise is a key facet. It's a niche element of the market, but if you get it wrong, it can be very, very expensive. You can lose a lot of value and a lot of.
Just to add, Zama, I think the one thing that's always easy to tell is obviously the explicit fees, where you're seeing commission, you're seeing the taxes related, but the implicit costs are usually a lot bigger. From a trading point of view, you're trying to manage market impact versus opportunity cost for that fund. And if you're not getting that right, by the end of that transition, you could be lagging peers by a long way. And obviously your pension fund has suffered in that process. So that is definitely one of the reasons you'd want to go with the transition manager.
Okay. David, I want us to maybe unpack the phases that you mentioned earlier in the conversation.
Yep.
If you can just maybe take us through, maybe even it's just the project management, reporting, and then maybe Kagiso can just kind of give us a little bit more on the execution side.
Absolutely. So there are three phases. I suppose they are equally weighted, because every phase you need to get right. If you get any phase wrong, you do not have a successful transition. So you've got to make sure that you're in the right place for each phase of that transition. So I guess the way I think of it, I'd almost look at it sort of, we've got the pre-transition steps, okay? And what I mean there is they are feeding into the project management. So they are checklist calls with all the stakeholders, the managers, the custodian, any party to the transition. So again, making sure that everybody's on the same page, every I is dotted, every T is crossed. Ambiguity is, it's not allowed in transition management. There can be no uncertainty. So we spend a lot of time within the project management phase, making sure everything's documented and everybody knows what they should be doing through the transition. Yeah, ally that with the reporting element. So the reporting phase goes through the whole life cycle of the transition. Our job as a transition manager on the front end is to try and, as I said earlier, quantify those risks. Look at the portfolio you're selling, look at the portfolio you're buying, try and figure out what's driving the potential risk within the trade. Is it liquidity of some of the underlying names? Is there a concentration risk within the portfolio? So we work with clients to highlight those risks and to build a strategy to manage those risks. And on every single analysis, we'll put together a cost estimate in advance of the transition. So we'll have identified the risks, and we'll be able to measure the expected costs, which we'll always refer to through the transition. So through the life cycle of the transition, we know if we said it cost 15 basis points, we want it to come pretty close to that 15 basis points post-execution. So we report on the front end, we report through every single stage of the transition, and then on the completion of the event, we put together a really detailed post-trade report, again, bringing all that transparency.
Okay, just before we come
Sure.
to you, Kagiso, just a question. So at that point
Yep.
of the various phases that you've just outlined, who's part of the conversation? So is it obviously let's say in this case it's a multi-manager.
Yep.
Okay, let's use the multi-manager example. It's a multi-manager now informing you as a transition manager to say, we now want to terminate a mandate with
Yep.
manager X, we want to move to manager Y.
Yep.
So you're having a conversation. The custodian, are you also having a conversation with the custodian?
We are in tandem, yeah. So I suppose the steps are a client, a multi-manager in this case, will contact us or we'll develop a conversation. We'll understand their expectations, we'll understand their timeline, we'll understand any sort of variables or factors that they're working to. They will then make introductions to their partners, the custodians, the managers they're taking assets from, and the managers they're moving assets to. And it's our job then to really get into, again, those weeds and start working with those various parties on behalf of the client.
Okay, all
Yeah.
right. No, thanks for clarifying.
Thank you, Zama.
Okay, so Kagiso, the last phase, the execution.
Yeah. So, yeah, I mean, the part that I'll just add to what Adam said, what Dave said, but an essential part of it is obviously the pre-trade analysis. If you're looking at asset classes and you're looking at liquidity, you want to see what kind of tail end this portfolio is going to have. You might find that 80% of this portfolio is quite easily tradable, but the tail end is where the costs start piling up because it means longer time in the market, long exposure, and obviously there's leakage, information leakage, and those kind of end up in bigger impact on your portfolio. But on top of that, you obviously want to look at your liquidity pools. For instance, we as Standard Bank will have access to liquidity pools in dual names in London. We'll have we'll have systematic internalizers within Standard Bank where we can actually match off. So you want to analyze whether those things will reduce the impact on the tail end of that portfolio. So that will be included in the pre-trade analysis. But more importantly, obviously, end of the day, how it's executed in the market is also important. For instance, will we be crossing quite a lot of that across institutional clients or being able to place those blocks? The bigger blocks we can place, the more we can place, the less impact, the less time we have in the market. So that kind of analysis, and that will give us, I mean, we've got institutional knowledge of the clients that we deal with on a regular basis. We know, for instance, at a very liquid stock, we know where to approach and with the least impact. So all those are important, but just to also add, obviously, there's in settlement, there's also settlement process that happens because trading just doesn't end there. But if settlement process is also not intact, what could happen is that you end up late settlement that exposes you to overdraft risk and more costs for the pension fund. So all that process is included in the execution part of this whole thing.
Okay.
And so, yeah, that's what makes it most efficient for the client.
Yeah.
I'm just curious, because you do this a lot, what tends to work best for the target client in this case? So, because I've been party to a situation where there was a transition happening, and the target, no, I think it was the legacy manager had a preference to rather kind of align the common stocks that they owned in their portfolio with the target portfolio, but the target manager had a preference to get the cash.
Yeah.
What tends to work best in your experience?
I think it also depends on the portfolio, right? I think there's no one size fits all, and then maybe that's why you need the expertise to get involved. But an important thing, I mean, we're not there to dictate what the client wants or doesn't want, right? I mean, we're given a mandate. This is what we'd like to do. This is how best to do it. And if a client does want cash, I mean, we could work towards that. But yes, the least impact and least time in the market is done by actually just transferring assets where they match in portfolios. In SA, I mean, typically you're getting 80%, 80-20, where 80 matches, 20% doesn't, and that's the trading part. so that portion is the part that we will likely manage the most in the market. So yeah, there's no set strategy. I think it'll depend on it's unique for each situation.
I think the important thing is to give the client an opportunity to look at more than one option.
Yes.
And that's really where a transition manager can come in and do a pre-trade analysis of what is involved in getting from legacy to target. You know, and it doesn't, and David, it doesn't always make sense to have a transition manager.
Correct. So I think you've both made really, really good points there in relation to the fact that, you know, one size doesn't fit all, but optionality is important. And when we look at the various options, we're also looking at sort of the pros and considerations, the pros and cons of those options. So we're, I suppose, assisting the clients, I suppose, to make as informed a decision as possible based on their objectives, okay? At the end of the day, it's what works best for the client, whether it's an asset owner or a multi-manager in the example you used.
Just to add one last thing, I mean, there are situations where pre-trade analysis can be done and it doesn't result in a transition. You know, So, but as they've mentioned, it's the optionality and actually knowing the risks before taking a decision, and that's where we're at. Yeah.
Okay, now you've mentioned risks, Kahi, so can we maybe just share some examples of some of these risks that could happen and how you would mitigate them should they happen during a transition?
Yeah, okay. I mean, I'll speak on the execution part.
Yes.
I mean, I think,
and then David can come in later.
On that. But I mean, execution risk is something that people face daily in the market. All right, it's not unique to a transition, but something badly executed has an impact on the incoming manager and on the outgoing manager. Right. For instance, a simple example: if you're a holder of a certain asset in a class and it's badly traded in the market, let's say you're selling for that, the market impact that you're having does not only impact the price on what you've sold, but your holdings as a portfolio manager are losing value because they're marked at the end of the day by the same price. So that's one risk, but there's also opportunity risk for the client. The longer they're away from benchmark or out of the market, the more tracking error they have, and therefore performance for that pension fund is also impacted. There's also other liabilities. For instance, as I mentioned earlier on, if settlement is not done correctly or the middle administrative process, it can result in overdraft costs. Those will be paid by the pension fund. So there's a lot of steps in between, a lot of risks, pitfalls that need to be identified before you actually pull the trigger. Yeah.
It sounds stressful. You're very calm as you're explaining all of this, but I'm just thinking all these things that can actually go wrong during the situation. But you're looking rather calm. Okay.
That's good.
Okay. And then from your end, David?
Yeah, so, you know, I suppose go back to your calmness point, Zama. I'd almost like align what a transition manager is doing with, I suppose, what a pilot does anytime a pilot gets into the cockpit. So it's very heavily laden in checklists. So every single time a pilot looks to take off, he or she will go through a very elaborate checklist to make sure that those risks that we've just talked about, we've managed them, we know them, we've got mitigants in place for it. So, you know, the planning we do on the front end, managing through the operational risks, making sure, again, everybody knows what's expected of them through the transition, to me is key. You know, we can have the best execution through the trade desk, we can have the best reporting, but if some element of the transition or some stakeholder isn't on the same page, you have challenges then. So documenting, and again, really, you know, taking a very stringent approach to the project planning and managing through that operational risk.
Okay. Now, Adam, coming back to you now, why would a client pay for this service?
Well, not all clients pay for this service.
Oh.
Do
explain.
There are a couple different pricing models. So the model that we follow is very much the money that we make is captured in the commissions that are charged on the trading that has to occur. So when everything is matched, eventually you have buys and sells. And the way in which we make our money is through the actual trade execution. So it's brokerage fees. And you can argue these are fees that if you didn't have a transition manager involved, that those commission rates would still be there. In fact, we'd probably argue that a transition manager typically has very attractive execution-only fees. So that's a very common model. That's a model that we subscribe to. But there are other models out there that might have an element of that, but also a project management fee. And in that instance, there would be a fee that is paid for the service. And why would the client do that? For all those points we made previously, to understand and manage the risk, understand where all the cost is going, and really to be able to report back to a board, a governing body, to show that the governance is there from a transparency and reporting point of view. So, David, I'm wondering if you should touch on the post-trade reporting that's done.
Yeah.
So, but maybe before we proceed with David's
No problem,
comment, I just
Zama.
want to get clarity of what you've just said, Adam, because I did not expect you to say what you just said.
Okay.
In terms of, it's not always necessary to pay a fee for this. Is it true then to say there is an element of flexibility in terms of how, so for example, let's go back to the multi-manager example we've been using throughout our conversation. Would I be able to say to a transition manager, I don't want you to conduct the whole process for me. I just want you to do the pre-trade analysis. Is that what you called it, right? The pre-trade analysis. Or I just want you to do the project management. Or I just want you to do is that possible?
So the pre-trade analysis, you'll find all the transition managers would come, and think of it as a quote, so to speak. So all the transition managers are very happy to provide a proposal, a quote on what they see the cost being, the strategy in which they would implement to get from legacy to target. So that's pretty much a given. You should be able to, and you will, be able to source that from all of the transition managers, us included. The other components, I think on some really, really big trades, big transitions, you could find multiple parties that might just be running a project management where they want somebody else to do the trading, and therefore there could be a fee involved just for the project management. That's fairly uncommon in our markets. So it typically, if you appoint a transition manager, all of the reporting, the post-trade reporting, the project management, and the coordinating of the trade execution is handled by that transition manager.
All right.
With some exceptions, yeah.
Okay, great.
Yeah.
Thank you for
What
explaining.
you also, I guess, find is sometimes, it's a function of size, all these things are. So you do find that some of the smaller types of transitions might warrant just a flat fee. That a client is very happy and they understand the value that a transition manager can bring. But in order for it to make financial sense to the transition manager, because maybe there's very, very little trading, there could be a number of different reasons, you could find scenarios where there is just sort of a flat administration project management fee charged.
Okay,
Yeah.
no, I understand.
Okay.
Great. Let's come back to you now, David.
Sure,
There's something that you wanted to add.
So I suppose much of what Adam sort of referenced there goes back to some of Chagisa's comments earlier on about that one size not fitting all, and the degree of flexibility. So although it may be atypical to sort of dislocate the various elements of the transition, it can be done. And I think, when we think about sort of that reporting element and some of that post-trade reporting that goes into the transition where we're quantifying those risks and referring back to that pre-trade estimate, I think that's a really important facet so that the clients, the multi-managers, the asset owners, they full visibility of the costs and where those costs emanated from.
Okay, no,
And
great.
I think just to add some, despite what he's saying, there's always a risk the more people you get involved in any project, right? And to split every step between different people, you're adding more risks and more potential pitfalls. So one project manager typically works more efficiently, I've come to see.
Yeah, no, I understand that. I suppose too many cooks spoil the broth, eh?
Correct.
Yeah, so
Correct.
let's not complicate things.
And I think as well for some of the more illiquid elements of the market, particularly in the local market here in South Africa, too many cooks, too many people with that information in relation to what you're doing. Information leakage is key. So you want to keep that contained, incubated with as few people as possible. So again, as you're working through the transition, you're managing and you're controlling your own information.
And it also touches on the trading because you want to be as discreet as possible, especially when you're dealing with very liquid assets. So definitely the less people in the room, the better, especially from a trading point of view and looking at the portfolio. So yeah, that's a potential risk for the assets as well.
Just talking about the discreteness element, I actually didn't think of this. Do you have to sign NDAs?
Yes, there's NDAs
Yeah.
involved.
Even typically to provide that pre-trade analysis, transition manager will sign a non-disclosure agreement.
Okay.
Yeah,
Yeah.
absolutely.
Okay. All right. Okay. Interesting. David, let me come to you. So let's say again, multi-manager example. I am considering appointing a transition manager.
Yep.
What should I be looking for?
I suppose it goes back to the various components of the transition. So when I think about it, and we touched on this, expertise, right? So if I was in the shoes of a multi-manager, or I was in the shoes of an asset owner, a principal officer at a pension fund, I'd want to work with a transition manager that has been providing transitions for a good number of years, has the technology to support transitions, and has the reporting infrastructure to report on transitions. So I would say expertise is key. How many transitions do they work on an annual basis? How core is it to their offering? And then, we talked about the pre-trade estimate and the post-trade. How often are their post-trade costs aligned with their pre-trade costs? How do they manage those risks on the tail end or on the back end of the transition? So that's very, very important. I'd also say having a depth of team. It's a lot of times when we work with our clients, it's a material element of their portfolio. So it's not really sufficient to have a single person or two people working on the transition. It's a whole team's got to be behind it and a whole team supporting it. So not being overly reliant on that key man or that key woman risk where you're facing off with one individual at an organization. So having that breadth of team. And then, as we talked about, having access to liquidity, being able to go to market.
Yeah.
And I don't know, do you want to speak to?
I think it's actually quite an important part. For instance, Standard Bank pairing up with Northern Trust. Standard Bank can access markets across Africa and dual markets and thing. But Northern Trust is an international bank that can help us in markets that we can't reach. And with transitions becoming a lot more complex, people moving offshore into different asset classes, there's fixed income involved, there's all that. You require a lot of expertise. And from a global markets floor at Standard Bank, we've got access to the fixed income desk, we've got access to the FX desk, the biggest FX desk on the continent. So you need those expertise involved when the time comes. For instance, if we're looking at very illiquid bonds in Africa, you will need the expertise of the fixed income desk. So if you're choosing a transition man that doesn't have access to those, it means he's probably have to go and subcontract someone else to help them. That's already information leakage, costs blow out at that point.
Okay, no, I think those are all very important. Adam, I know you alluded to the portfolio size. Is there a specific minimum? I can imagine it depends who you're talking to.
Yeah.
Okay, but to kind of make it worthwhile for a transition manager, what kind of portfolio sizes are we talking about?
In our markets?
Yeah, in the South African
look,
context.
There's always exceptions depending on the client, depending on how much you've done with them in the past and the relationship. But you probably draw the numbers somewhere around 150 million rand, somewhere in there. Plus minus, yeah. Okay,
well, that's good to know. And then, David, I'm all about performance appraisals in general.
Good.
So tell me, for an institutional investor who has appointed a transition manager, is there a way to assess how well the transition manager has done?
Yeah, really good questions, Emma. So I think, again, we're belaboring the point, the reporting. It's all about the reporting. It's all about that cost transparency. So when we put together a post-trade report, so a post-transition analysis for a client, what we're doing is we're looking at every single execution that's gone through the transition, and we're measuring it versus a benchmark. And this would be a pre-agreed benchmark with the client in advance of the transition, the multi-manager in this case. So we put together a fairly detailed quantitative report that we share with clients. We highlight the cost within the transition, and then we attribute all that cost. So again, this is the awareness, there's the oversight, there's the governance there. So there's a strong quantitative element, but I always say there's a huge qualitative element as well. So in my eyes, measuring the success of a transition is based on the feedback from your clients. So a client will come and say, yes, we understand every aspect of the transition. the daily updates you were providing were excellent. What we needed to report to our investment committees and to our internal partners, and I suppose client satisfaction. Will they be a referenceable client going forward? So it's that combination of quantitative, deep, transparent reporting, and qualitative, positive feedback on the back end of a transition.
Are there consequences if you don't meet what was previously agreed to?
So every transition that we work on is governed by a legal agreement. So obviously, if you breach the legal agreement, there's consequences. But typically that's not the path we're taking. So when we're working on a transition, because we've got our pre-trade estimate and we've got a sense for what the transition should cost, if markets move against that transition, it's our job to keep the clients informed. Okay, so let's say, for example, you're transitioning a portfolio and you've got an overweight to financial securities. And on the day you're trading, so you've got a big basket of financial securities. On the day you're trading, there's bad news in the financial sector. There's an accounting issue or an irregularity at a bank, and the bottom falls out of the financial market or the financial sector. So you're now selling securities into a market that is falling away. And as a result, you might be outside of your cost estimate. But it's our job as a transition manager to pick up the phone, call our clients and say, for awareness, we are a heavy seller in the financial sector. We talked about it through the pre-trade estimate. We can see what's going on in the market here. Do we need to have a further conversation about it?
Just to add, I think it also gives us a chance to kind of mitigate risks, right? At that point in time, do we go back to the client and say, okay, let's do this. Let's change our trading strategy.
Correct.
Should we not hedge some of this position at some point? But as I said, the expertise on the floor allow for that,
Yeah.
right? And so these are constant, especially the trading part of the transition. It's a constant communication with the client if things are moving very fast, especially this day and age. You can see gold miners and precious metal miners rally 10% in a single
Correct.
day, and those are heavy positions in portfolios this day. So we have to be dynamic. You can't say this is the strategy at the beginning and this is how we're going to end. No, that there has to be a constant conversation.
But
Yeah.
Zama, I think one of the consequences is if the client isn't happy with what you've delivered, then there's a high likelihood you're not going to be working with that client again.
Fair enough.
So
Yeah,
we're
you
highly
won't be invited.
incentivized
Yeah.
to get it right.
100%, 100%. But again, going back to sort of that estimate, and if markets are moving or there's a macro pressure that affects the transition, it's those conversations, it's those fluid conversations, it's the ability to dynamically adjust your strategy and communicate that to your clients so that they know throughout this transition you are working with their best interests to the fore. Some of those challenging transitions can be, some of the most rewarding transitions from a client engagement perspective, because they know they've hired somebody to manage through a turbulent period in the market and they've done it effectively.
And I suppose the point that you made earlier, David, around the depth of the team is even more important when markets are so volatile.
Correct.
You need to have a lot of hands on deck
Absolutely.
to kind of navigate the
Absolutely.
volatility in the market.
Yeah. And expertise and experience, and having traders that have been in the markets for decades and have seen various market cycles and know how to adapt accordingly, and having partners like we have at Standard Bank who have got that local expertise in the markets we trade in. It's absolutely it's a vital importance, Zama.
Yeah. Now, Adam, so coming back to you now, we've obviously seen some interesting changes in legislation in South Africa in the past 3 odd years. So 3 years ago, we had the changes to Regulation 28, and then last year, in September, we had the implementation of the 2-part retirement systems. And I can imagine in both instances, there would have been some significant portfolio transitions that would have taken place. Are there any interesting trends that you observed?
Well, just in terms of the uptick on with Reg 28 to the 45% limit offshore, we did see a bit of an uptick in terms of transition management demand for our services in this space. We assisted a handful of clients as they liquidated local holdings and went offshore. That was largely in 2023, because I think that came out in April. So I guess you would expect that you might see the inverse of that now that the markets are just so strong here. We have, call it dollar weakness, rand strength. We haven't seen it, but we anticipate there could be some reverse movement where offshore assets are sold down and the seeding of of local assets are taken up. In terms of two-pot, I think the jury's still a little bit out in that, from what we can see, the savings pot and the retirement pot are pretty much the same strategy still, okay? And that could be for a number of things. One might be that the administrators still aren't quite completely geared up to handle the two different strategies. It makes sense, though, that for certain funds, they would employ a different type of strategy for the savings pot, one that's more stable, not as exposed to volatility. I don't think we've really seen that as an industry yet. We do anticipate it, and when that does happen, we are in a good position to assist those funds as they move from the retirement pot into a different type of strategy, into the savings pot. So yeah.
Okay, no, that's interesting. Yeah, because I just wondered in this space if there were any big changes that you had observed. And then, just out of interest, David. Based on your observations, are there any notable differences or similarities between the global and the South African market when we look at transition management in general?
Sure. So I would say, as is typical with most transitions, there's probably more similarities than exceptions. So there's a lot of commonality between every single transition we work on, and little nuances or idiosyncrasies around the edges. And I would say that's the case in a lot of the markets we work with as well, or work in as well. So if I look at the local market here in South Africa, probably the big differences or some of the key observations are, it's local providers that are working with the asset owners and working with the multi-managers, whereas I think of outside of the South African market, typically it's big global organizations like ourselves at Northern Trust. One other key element is when we work with fund structures, so commingled structures, we do a lot of movement of scrip assets. So we take assets in and out of funds on a fairly regular basis, which doesn't seem to be as typical here in the South African market. And I don't know, is it just a reluctance or I suppose challenges on the operational front? But from a cost savings, it can be very, very beneficial to a fund. Again, go back to Kagiso's comments around commonality. Sometimes we see 80% of this fund looking like this fund over here. So why would you sell down to cash to then try and reinvest and buy into cash? It doesn't make sense from a cost perspective. So the flexibility and the use of scrip assets out of funds and into funds probably is more typical in some of the other markets that we work with. So I'd say, from my perspective, they're probably the two key differences.
Okay,
yeah,
that's very interesting. And then, Kagiso, in your mind, where would you like to see this sector evolve? How would you like to see it evolve, and where would you like it to go?
Especially in South Africa.
Yes, in South Africa specifically.
I think there's still a lot of room, and it's probably an educating process. I think transition management is not new to South Africa, but it's underutilized, I suspect. And there definitely should be a lot more, especially multi-managers looking at this. I think the cost of moving between funds is something that's not deeply looked at in South Africa. Also just trading costs in total. I think funds have not really looked at trading costs as in-depth as they should, and the level of impact it actually does have on their performance. You compare two managers, one that's traded very badly and one that's traded well, but the same kind of assets, and it's impacted performance, So I think that's something that needs to be deeply looked into, and hopefully with these kind of conversations, people do start looking at the execution part of this process, and not just transition, but trading in total, and just seeing what effect is actually happening on their funds. And that's where I think it should be going, yeah.
Okay, great.
Yeah.
And then finally, Adam, I'll end off with you, the salesman. If you can just please, I know David touched on the relationship with Northern Trust with Standard Bank. Can you just maybe elaborate on that? Sure. And then maybe just, for our viewers watching this segment who are about to transition portfolios and they haven't necessarily appointed a transition manager, and now that they've listened to our conversation and they understand the benefits of having a transition manager in the first place, and they're thinking, okay, maybe we should consider this. Why Standard Bank? If you can do your pitch.
Well, yeah, maybe just to describe the relationship we have with Northern Trust. So Next February will mark 5 years since we set up what we call a transition management alliance with Northern Trust. And the way, and prior to that, we contemplated doing all these things we've discussed on our own within Standard Bank. And you could argue we have a lot of the tools, and we could have put that together. But to us, it made sense to, to really focus on the strengths that we have here, which is understanding the client base, the local markets, the liquidity pools when it comes to executing, but finding a global leader that could come in and help with all of the intellectual capital, if that's what it is, associated with running transition management from a pre-trade reporting, post-trade reporting, compliance overlay. And we found that in Northern Trust. Northern's has been in this space, I think, close to 40 years. They're a global leader. And to us, it just made sense to put what we're really strong at together with what Northern's is really strong at. And that's what we've done. So that's our story.
Okay, fabulous. And it's been a great partnership today.
It absolutely has.
Fabulous.
Absolutely
All
has.
right.
Yeah.
I think then we'll park it there, gentlemen. Thank you so much for sharing your insights on this interesting topic. I mean, I definitely learned a lot myself. I didn't really know much about it. So Adam, Kagiso, and David, thank you so much.